Hello, everyone. In this video, I want to talk about temporary 2-1 buy downs and how it lowers the rate on your mortgage by 2%. So, first things first, just know that there are multiple types of buy downs. Specifically, in this case, we're looking at the main two, which is permanent and temporary here. And I actually did release a video earlier on permanent buy downs. It's actually called lender credits, or sorry, points and lender credits. And it basically shows you what happens when a borrower or seller decides to pay a certain amount of points, which is a percentage point based on the loan amount to lower their rate, right? So if you pay more upfront, you can have a lower payment and lower rate. So permanent buy down is basically just that. It's the interest rate, a decrease of the interest rate over the life of the loan. So it'll stay that way forever, depending on what you buy it down to. And just like a temporary buy down, there are seller paid and borrower paid options. So they both have the option to do that. And the one thing to know, and this is the main difference I would say when comparing the options, is that permanent buy down is, it's a cost. It's kind of like an investment. So there is a break even point, right? So if you invest, $5,000 to lower your rate and lower your payment by $100, you want to make sure that you get that savings covering the initial investment, right? So if you pay off the loan before that, or you sell the house before that break even point, then you lose money on that investment. You don't recuperate basically everything that you could have. And on a temporary buy down, it's basically the decrease of the interest rate for a specific term. This term that we're talking about in this presentation here is 2 years. And again, same thing, seller paid and borrower paid options. They can both do it. And the way that you want to think about this is, since you're paying less in the first 2 years, the difference between what you're paying the first 2 years versus what is actually supposed to be paying on a normal schedule needs to be put into an escrow account, and that's the cost. So let's say that cost is $10,000, but in the first year or the first 2 years, really, you decide that you want to refinance or sell the house, and there's a certain amount of money left over. Let's just say there's $5,000. If you do that, the $5,000 will go towards paying off or paying down the principal amount. So it's not like that the money just disappears. It'll still be a principal reduction. So how it works is basically that you'll have a 2% reduction in the rate in the first year and a 1% reduction in rate in the second year. And then it'll go back to the normal rate and the qualifying rate really for the remaining term. So for example, if market rates are at 6%, year one payments will be based off a 4% rate. Year two payments will be based off a 5% rate. And then from there, we'll go back to that 6%. And the funds to do this are collected at closing again and placed into an escrow account. And those escrowed funds are used to cover the difference in the payments. So here's an example. This will be, obviously we're looking at different rates here, and this will be a different loan amount. So if we are paying or really qualifying for a rate based on 5%, and that payment is $536.82. So technically that payment needs to be made every single month. But in the first year, the borrower is paying on a 3% rate. So the payment that they're making is $421.60. The difference between those two payments is $115.22. So if that's what we're going to be making for the first 12 months, we need to have 115 times 12 in the escrow account. Same thing for the second year. You're going to be making a little bit of a higher payment because you're paying on 4%. But so the difference is about $60. We'll have that times 12 in the escrow account, which is a total subsidy of $2,095.44. So each month we'll be drawing from that subsidy, from that escrow account, to make sure the payments all line up. So I actually have another example here that I want to show as well. And this will be a bigger loan amount and the different rates. So you'll see the differences here. I am really using a purchase of $1 million, 20% down. So you have an $800,000 loan amount, and we have a qualifying rate of 6.5%. So the borrower that's getting this loan here needs to qualify for this payment here, for this loan, the $6,439 payment. And that is principal, interest, taxes, and insurance. And I'm just showing these other two scenarios here at this loan amount really with these rates so you can see the payment difference. But in year one, with a 2-1 buy down, they'll be paying on a 4.5% rate, and their payment will be $5,300, which is about $1,100 cheaper than what the year 3 to 30 payment will be. Likewise, as you would expect, year 2, 5.5% rate, payment goes up to $57.92, but it's still about $650 less than what your actual payment is going to be. So this cash to close represents the down payment, which is about $200,000, closing costs, and the subsidy to do this. Now, in this case, what you want to do, right, is you calculate the difference in these payments, these two payments, that's your subsidy years, compared to this, that's your actual qualifying payment, and you'd multiply it by 12. What that gets you is, I know I already calculated, in this case, will be about $18,000. So again, like I mentioned, the borrower or the seller can pay these. And depending on the market, for example, it's usually more optimal that the seller pays it, and that usually represents about 2.3 points. And like I said before in the other video, really points is a percentage of your loan amount. So 18,000 is about 2.3% of $800,000. So we've seen sellers contribute between 2 and 3 points depending on, again, the market that we're in. So if that's an option that you can negotiate, I would look into that, because again, that $18,000 will go towards paying down your loan amount if you decide to refinance or sell the home or whatever it may be in the first 2 years. And that's a pretty cool program, honestly, for especially for people that maybe want to start off with a lower payment, like $5,300, and then ease their way into their $6,400 payment. Again, hopefully this was valuable and helpful. If you have any questions about this program, you want to see your own scenarios and maybe walk through it again, please let me know. Either just reach out to me however you can or comment below. Other than that, yeah, let me know if there's anything else you want to see. I would appreciate any likes, comments, and of course, please subscribe. And I hope that you all have a great day. Thank you. Bye-bye.